Welcome to Investors Guide. Happy New Year to you. After Diwali, I hope you had a wonderful week and it's now back to work on our investments. We're going to, over the next half hour, answer some very big questions, something I know that's bothering all of you. So you should grab that pen and paper and write down our email ID. If you have a question, get in touch with us. First up on the show, it's the big question we're all asking. If you have money to spare, should you be repaying your home loan or should you be investing in mutual funds instead? In our product review, we look at the UTI Equity Fund and we find out if you have adequate health cover and how you should bump up that health cover if you don't. All right, let me introduce Narendra Kumar, the CEO of Value Research. Narendra, thank you so much for joining us. We have a very interesting question that has come in from, one of our viewers. 35-year-old Anshul K has written in from Bangalore. He tells us he's made his goals, 5.5 crore rupees for his retirement. For his daughter, he seems to have one daughter. He'd like 1.525 crore rupees for her education and 1.25 crore rupees for her wedding. You know, Anshul, I want you to step back and consider the fact that you are planning on spending the same amount of money on your daughter's education and on her wedding. It would make me far happier to see you write down 2.5 crore rupees on her education altogether instead of having to allocate for the wedding. But it's your plan, so you go ahead and do what you want with it. He also wants to save some money to buy an SUV and take his family on vacation over the next 5 years, and to put together a contingency fund in the range of 1.5 lakh rupees. He sent us some details of his plan. He has an income of 1.5 every month. He pays a home loan. He has a term insurance policy and medical insurance provided by his employer. Now, when we just look at his goals right now, does he have enough time to put all of this together, Narendra? Because he's made a very elaborate plan, but I want you to first just look at his goals. And, does he need to move any of those goals around from where they are?
Yeah, he has reasonable time, but may not be enough time for the ambitious goals he has set for himself. And also adequate, accumulation or adequate savings to support that. But I assume that, somebody who's 35-year-old and still 25 years away from his retirement, he might have time on his side, but, he'll have to negotiate some of the timelines. For example, the retirement can be extended, and also we are making a linear estimation of his income, and things might change dramatically for him as he gets into a different cadre. And that is something which he is best positioned. He can only estimate those things, the future prospect for his for his role in whatever job he's doing.
Get organized, prioritize things better. Of course, remember, there might be some goals here that are slightly flexible, like your daughter's education in 16 years, you can't move. It's going to come up in 16 years. But the retirement, the SUV perhaps, or the holiday would be slightly flexible. So consider moving those dates around to give yourself more time to accumulate, because your goals, like Narendra said, are quite ambitious. And we really do hope that your income rises dramatically over the next few years and you're able to contribute more to your investments. Narendra, he's set aside some investments per goal already. Let's look at his retirement. He has NPS, EPF, HDFC Prudence and the IDFC Premier Equity. My worry is that his retirement corpus or his retirement plan might be too debt-oriented, considering he has as much time on his hands. EPF, NPS, HDFC Prudence, none of them are really aggressive. Should he be going more aggressively into equity?
Yes, otherwise he will not have a peaceful retirement. And in fact, this is the kind of portfolio which should be there just before he's about to retire. This is the kind of allocation. It will translate into an allocation of about 50%, 45-50% into fixed income, remaining into equity through these investments. Which I don't think is desirable at this point. He should be, all his investment discretionary investment should find its way into equity. So if NPS he has a choice, which he might have, then it should be in equity. His EPF, he should make the minimum contribution to EPF, and rest of the money which he'll save on that account should go into equity. Likewise, there is no role of a balance fund right now, and only when he is 5-7 years away from his retirement that he should work towards making it a little more conservative investment, not necessarily ultra conservative, because that money has to remain for a long time. Even if you retire at 60 and plan to spend that money over the next 25 years, it should be in a form which is able to beat inflation.
Let's also look at his daughter's education. The plan he's made for his daughter, he has 5,000 rupees going into the UTI Mid-Cap Fund, and the Franklin India Feeder Fund, he has 10,000 rupees going into. For his daughter's marriage or the wedding that he's looking at, he says he has real estate and, Narendra, 1 lakh rupees in gold bonds. Again, I worry that he's going to be very disappointed with what he has at the end of the 16, 20 years that he has as a time horizon for both of these goals, whether it's his daughter's wedding or her higher education. It doesn't seem like he has a proper plan in place.
Definitely not. And I think, gold could be, he could be in for a big disappointment. Gold bond is a good idea if you have to, relative to other options, other mechanism of buying gold. But for 15, 20 years time frame, I think gold is a bad investment. If it is invested in an equity fund or even in a balanced fund, you'll be able to buy much more gold 20 years from now. So from that standpoint, it is not a good economic decision. But I would urge that financial investments are made to optimize your return and convert them into, gold. You should look at consuming it. If at all you need the gold 20 years from now, you will have much more money than the amount of gold that, you will accumulate by way of these gold bonds.
Well, also he has ICICI Focus Blue Chip, 10,000 rupees a month. He's putting that money aside for a car, and the Birla Sun Life Treasury Optimizer Fund, which he's using to save for his family vacation, Narendra. I'm tempted at this point, and I know we've spent a fair amount of time reviewing his portfolio. I'm tempted at this point to just recommend one of the portfolios we have designed on the show, which might suit him better, because he has two buckets. One is 5 years away, the other is about 15 to 20 years away. Can he just use two different portfolios of ours and be able to solve all of his problems?
Yeah, actually, the contingency of the family vacation and the SUV, which is on his radar, they are very near term, and that is the money which he should be, it should be achieved even earlier, going by all the fixed income allocation he has in other portfolios. He should be able to achieve that faster, and think of all these equity investment as his long-term investment. Invest as much as possible. I don't think it is possible to be very precise with your plan, because there are too many moving parts here. The amount of money which you estimate you need 20 years from now will be in for a radical change. Likewise, your income, which is the primary driver of the amount of money which you will be able to save, will change substantially. So it's important that you actualize some of the immediate goals even faster, earlier than the 5 years that you have planned for.
Right, focus on your job, and Narendra, they're saying, take a close look at all of your goals. Remember, if you have questions about anything you heard on that answer, you can get back in touch with us. That investment IRR that you're expecting, the return that you're expecting of about 12% should be achievable in equity. But you have to look at your allocation. You're not completely in equity. Your NPS or your EPF or all of these other things, your balanced funds are part equity, part debt. So then it would be unfair for you to expect 12% from investments like that. Write back to us if you need anything else. Narendra, this is another very interesting question. The reason why we picked it is because there are so many viewers right now who are asking the same thing. 44-year-old Indran has written in. He has a home loan balance of 30 lakh rupees at an interest of about 10% for the next 10 years. He says he has about 30 lakh rupees to spare right now, and he falls into the highest tax bracket. So, should he repay the home loan and then he'll lose out on that home loan tax deduction, which is so important for him if he's paying 30% tax? That's one option. The other option is to invest the money in mutual funds. In that case, will the mutual fund return, he's asking, beat the home loan interest rate of 10%? What would you recommend, Narendra?
Just looking at it as a plain economic decision, 10% cost, and I'm confident that on a 10-year investment time frame, one is likely to derive substantially superior return on equity. But important thing is, don't miss on the don't skip on that basic rule. Just because market has not been going anywhere, don't get tempted to invest at one go. Stagger your investment at least over the next 12 months, maybe 18 months, and despite that you will have 8.5, 9 years and I'm confident that it will generate substantially more return than what the cost of your home loan.
All right, so there you have it. Unless the EMI is, really, really bothering you on your family budget on a monthly basis, and you'd really like to either bring it down or get rid of it, Narendra is saying, Narendra recommends investing in mutual funds. And of course, we have portfolios designed for mutual funds depending on your time horizon of investments. Ideally, we'd like it to be 10 years or more, considering you're looking at beating that home loan. Write to us if you have any more questions. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. This is the most interesting part of the show, really. This is our product review. The UTI Equity Fund is the one we're looking at this week. Avan will give you a quick introduction. Avan.
Thanks, Faye. This week, we take a look at one of the large cap funds, the UTI Equity Fund. Now, this open-ended equity fund has had promising returns over the years. But how does its performance look in the recent times? A quick look at the fund's performance chart over the last 5 years shows why the fund has left investors disappointed. It has marginally performed better than its category and its benchmark average, with returns on the performance chart. In the last 1 year, however, the fund's performance has been lowest when compared to the rest of its peers in the category, with a return of less than 1%. However, the fund has had a good long-term track record despite the recent underperformance. The fund's recent returns may have left investors worried. But is that reason enough for you to exit this fund? Let's find out. With that, it's back to you, Faye.
Avan, thank you for that introduction. The UTI Equity is currently at 4 stars on value research, but the performance over the last 1 year might have led a lot of investors to think that maybe it's slipping. If you compare it to its peers and the rest of the funds in its category, how would you rate this fund's performance in the last 1 year? And do you agree that it's been slipping a little bit?
I don't think there is much to worry with this fund. This fund has consistently beaten its benchmark. It has been ahead of the pack for a while. Continuity of the fund manager remains. At the same time, the quality focus of the fund that I see and the selectivity that's visible, I don't think the relative underperformance, or relatively, I would say not underperformance, but little less, rewarding than few other funds in the category, should unnerve any investor in this fund.
So, Narendra, if I am an investor who's been investing for the long term in this fund, so maybe I started 2-3 years ago, how much longer do you think we should watch this fund before we actually start to get worried?
Give it a time of, at least 1.5-2 years. And that is how I feel that many other big funds, many of the other funds in this category, relatively bigger funds, are positioning themselves and waiting for the economic turnaround.
So don't lose hope on this fund just yet. And of course, remember, on this show, we are watching the funds very closely. So if you need to make a move, we'll tell you about it. Until then, don't panic. And most of all, when you're looking at your fund, don't compare it to how the mid-caps are doing and say, oh, okay, it's not doing as well, because you have to compare apples to apples when it comes to mutual funds. Narendra, I'm going to ask you to give it a rating from an investor's guide, viewer point of view. Should we buy it? Should we not buy it? On a scale of 1 to 5, where would you place this fund?
I would say that, most investors should continue with their SIP if they are on to this. And if you are invested, don't bother. I would give it a 4-star fund, 4-star rating.
4 stars for the UTI Equity Fund on Investor's Guide. If you have questions about that particular fund, or you want us to take a look at another fund that you're invested in, write to us. Our email ID is at the bottom of your screen. You can reach me on Twitter as well. It's time for our hold or sell segment. A 46-year-old Sandeep Nigam has written in. He wants to create a corpus for a home that he plans to buy, Narendra. He's been investing 59,000 rupees in mutual funds every month. I'm not sure why he's not investing 60,000 rupees, but he's investing 59,000 rupees. And he sent us a list of funds that he would like to invest in. Now, he's not given us a deadline for his goal of how many years he wants to invest for before he actually buys that home. But let's take a look at the funds he's picked. HDFC Top 200 right on top of his list, Narendra. This fund has been, has had a choppy relationship with investors. They've loved it and they've hated it and they've loved it again. Would you recommend he continues this investment?
Yes, he should continue this investment. And as I was saying in the context of UTI Equity Fund, that give this fund, despite its disappointing performance, this fund still also deserves, some time being given, and don't give up on this fund yet.
He also has the Quantum Long-Term Equity Fund, Narendra, and if he's investing a total of about 60,000 rupees, these two funds add up to 20,000 rupees out of that 60,000 rupees. So are you comfortable with that kind of a chunk of money going into Quantum Long-Term Equity?
Quantum long-term equity, there is one thing which I, dislike about this fund, where this fund takes a cash call, and many occasions it has, most recent past, when it actually took a great cash call, with great conviction, it did not play out well. I would say he should reduce his position there, though this fund still looks promising.
I'd reduce your position there. UTI Opportunities and ICICI Focus Blue Chip are the next on his list, along with iPro Discovery, Narendra. Let's look at Opportunities and Focus Blue Chip first. 5,000 rupees each into these funds. Continue those investments?
Yes, these are all good funds. And more importantly, one should look at it holistically, that what kind of fund he has. Looking at, SDFC Top 200, UTI Opportunity, Quantum Long-Term Equity. Focus Blue Chip Fund, which is going to be a large cap, or tilt his whole portfolio to large cap. And so important thing is that he should be into mainstream fund and be in fund which have reasonable flexibility.
All right, stay in a fund that has reasonable flexibility. He has the Mirae Asset Opportunities, the Franklin India Prima Plus and Franklin India Blue Chip. At this point, I'm starting to get a little worried that he has too many funds in his portfolio. But Mirae Asset Opportunity and the two Franklin India funds are both very good performers. Continue those investments?
Yes, continue those performance, and he should look at his own performance, ensure that the whole objective or his need for growth can well be better met with just 4 funds or 4 fund companies with the highest flexibility.
But he also has IDFC Premier Equity, Narendra. I know that you're going to ask him to hold this fund, but if you're saying just 4 funds with the highest flexibility, I'm just going to ask you to recommend 4 funds that he can use instead, because he's spread his money across all of these funds and he might be duplicating a lot of those efforts. Just tell us what 4 funds that he should be using ideally for a target like this.
Of his 9 funds, if he has to choose 4 funds, I would choose Prima Plus, IDFC Premier Equity, UTI Opportunity, and HDFC Top 200.
All right, on your list right now, Prima Plus, IDFC Premier Equity, UTI Opportunities, and HDFC Top 200. These are the 4 funds you need to go with. You don't need to have as many funds as you're looking at right now. 15,000 rupees in each of these funds and you should be okay. It'll also take your total up to a nice round 60,000 instead of the 59 that you have at this point. Narendra, thank you so much for joining us on the show and answering our questions. Welcome back. You're watching Investors Guide. Thank you for staying with us. It's time to answer your insurance questions, and Gajendra Kotari joins us right now. Gajendra, thank you for joining us. Our first question comes in from 30-year-old Krishnant Rathore, who writes in saying he has a 4.5-year-old son. Congratulations. And he wants to buy a family floater plan. He's looking for a medical cover of up to 3 lakh rupees. Now, he wants a couple of options, Gajendra. He also wants to know if he can add his parents, who are past 50 years of age, to the policy as well. And he tells us he's already included in his medical cover, which has about 1 lakh rupees, but he wants to increase that cover. First of all, I must tell you that it's very important to increase your cover. Your cover of 1 lakh rupees is not enough. And for just the nuclear family of your spouse and your son, even the cover of 3 lakh rupees is inadequate. I would like you to bump it up to at least 5 lakh rupees. Also, when it comes to your parents, our normal recommendation on this show is to buy them a separate health cover, because these family floater plans are priced based on the age of the oldest member. So you will all wind up paying more for your covers because the oldest member tends to be a little older. So a separate cover for them and a separate cover for yourself is what I would recommend. But Gajendra, are there options in the market right now that you'd like to recommend for them?
So for your age, the family floater insurance for a family of 3 would roughly come in the range of around 8 to 10,000 rupees per annum premium for a 3 lakh rupees family floater cover, which means any of the family members can utilize this cover. I wouldn't recommend including your parents into this policy, because then the premium would be pretty high. On the contrary, I would say, you can have a separate policy for them. So you mentioned that they already have a 1 lakh cover. The first thing I would recommend is that if you can enhance this cover within the same company itself to maybe 5 lakh rupees floater or a 5 lakh individual, if you can get it, that is the best thing. If the existing company is not able to increase the cover, then maybe you can shift to another company. And for your parents, for a 3 lakh sum assured, the premium will be of course higher because they are right now 58 and 56. So close to, I think, 20,000 would be the premium for a 3 lakh rupees floater for your parents.
Next question comes in from Prashant, who's looking to buy a top-up cover for his mother, who already has a policy of 3 lakh rupees. Again, 3 lakh rupees is not enough. Take it up to at least 5 lakh rupees. She has no health conditions. He's been facing problems because she's overweight. He wants to know if there are a couple of options that he could look at. Gajendra, that shouldn't be technically a reason to, deny her a policy as far as I'm concerned. But are there policies that you would recommend that he considers?
So the 2-3 conditions can happen here. A, the company can reject the proposal. B, the company can accept the proposal, of course, at a higher premium. Or C, the company can accept the proposal at a standard premiums. My first choice would be that, in whichever company you have the policy, try with that, because chances are there, you are already customer there, so they may accept this proposal. In case if they're not accepting it, then maybe you can try with another companies. There are many companies in fact which offer super top-up cover, but as I said, underwriting requirement is different for each company. They may ask to go for medicals or or further requirements, but there's no straightforward thing that this company will give or this company will not give.
Last question comes in from 28-year-old Rahul Kumar. He's just begun investing in mutual funds, and I'm so happy to hear that, Rahul. You're on the right track. He wants us to recommend an adequate term and a health cover for him. He shortlisted the Aviva iLife term insurance plan at 40 lakh rupees. What would you recommend? Well, Gajendra, he hasn't told us how much money he's making right now. But for a 28-year-old, I'm going to assume that his salary is going to increase in leaps and bounds in the days to come. So I'd like him to get the upper limit of the term cover. What would you recommend he does? How can a young person sort of pick their limit of term cover? What should he look for in a life cover?
With regard to health insurance, of course, it's very easy. You have to first check if your company is providing you any kind of health cover. If yes, then you can go for a smaller cover as a standby, rather than going for a full-fledged cover at this stage. So that is one option. With regard to term insurance cover, since you mentioned that you are unmarried, I would ask you another question: that is there somebody dependent on you at this stage, your parents or anybody else in the family? If yes, then of course you require term insurance cover. If not, then maybe you don't require the cover at this stage, because we normally recommend term insurance only if you have dependents, on you. So, but let's say assuming you have dependents, you can go for term insurance cover both on the online space and offline space. So at 40 lakh is a good cover which you can consider at this age. And Aviva Life Insurance is a good company. You can go ahead with Aviva Life Insurance, and the online version of the same will be very cheaper. So that you can consider.
All right, that's a wrap on Investor's Guide. We've run out of time. Remember, you can always get in touch with us if you have questions. Email ID is on your screen. A copy of the show will be on our Facebook page, and you can reach me personally on Twitter. Thank you so much for watching.